You finally saved up $30,000. Maybe it took you 2 years, maybe it took you 5. But it's sitting there in your savings account, and you're staring at it thinking, all right, what do I actually do with this? And immediately, your brain splits into 2 camps. One side is saying, buy property. Real estate is how real wealth is built. Every rich person owns real estate. And the other side is going, just throw it into the S&P 500. You'll average 10% a year, and you don't have to deal with tenants calling you at midnight because the toilet exploded. And you're just stuck, paralyzed. Because everyone has an opinion, and honestly, most of those opinions are based on vibes, not math. So today, we're going to fix that. We're going to run the actual numbers, side by side, dollar for dollar, and by the end of this video, you're going to know exactly which one makes more sense for your specific situation. And I'll be honest with you, the answer surprised even me. My name is Luis, and I spend way too much time thinking about wealth-building strategies, investment returns, and the psychology behind why we make terrible decisions with our money. If you're someone who's been going back and forth between real estate and stocks, and you just want someone to lay it out clearly without trying to sell you a course, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. All right, let's get into it. So here's how this debate usually goes. The real estate people say, stocks are just numbers on a screen. Real estate is tangible. You can touch it, you can live in it, and it always goes up. And the stock market people say, real estate is illiquid. It's expensive to maintain. And historically, the stock market outperforms it. And here's the thing. Both sides are technically right and technically wrong, because they're both leaving out the single most important variable in this entire equation. Let me start with what most people get wrong about real estate returns. According to data going all the way back to 1928, the average annual appreciation of U.S. residential real estate has been roughly 3.8% to 4.2% per year. That's it. Now, compare that to the S&P 500, which has returned an average of about 10.2% per year over that same stretch, or roughly 7% after inflation. So if you just looked at those two numbers, you'd say stocks win, game over, let's go home. But look, if it were that simple, I wouldn't have made this video, because that comparison is fundamentally dishonest. And here's why. Here's what most people don't realize about real estate. When you buy a property, you're almost never paying the full price. You're using leverage. Leverage changes everything. Let me show you the math. Let's say you take that $30,000 and you use it as a 10% down payment on a $300,000 property. Now, if that property appreciates at just 4% this year, it goes up in value by $12,000. You didn't invest $300,000. You invested $30,000. That means your actual return on the money you put in is 40%. 40% in a year where the property only went up 4%. Now, take that same $30,000 and put it in the S&P 500. A great year gives you maybe 10%, which is $3,000. A really great year might give you 20%, so $6,000. But in the real estate scenario, you made $12,000 on the same initial investment. This is the power of leverage, and it's the reason so many millionaires build their wealth through real estate. You're controlling a $300,000 asset with $30,000 of your own money. The stock market doesn't let you do that, at least not without margin accounts, which, if you're watching this video, please do not trade on margin. That is a different conversation entirely. Now, you might be thinking, okay, Luis, but you're ignoring the mortgage. You have to make monthly payments. That eats into your return. And you're absolutely right. So let's factor that in. On a $270,000 mortgage, at let's say a 6.8% interest rate over 30 years, your monthly payment is approximately $1,760. Over the course of a year, that's $21,120. Then add property taxes, let's say $3,600 a year. Insurance, another $1,800. Maintenance, which the general rule of thumb is about 1% of the property's value per year, so $3,000. Your total annual cost of owning this property is roughly $29,520.
Now, if you're renting it out and collecting, say, $2,200 a month in rent, that's $26,400 a year. So you're actually short about $3,120 a year. You're cash flow negative. And this is where a lot of real estate gurus conveniently stop talking. But here's what they also don't mention. A portion of every mortgage payment is going toward paying down your principal. In year one, roughly $4,500 of your payments are actually building equity. So even though you're cash flow negative by $3,120, your net equity is increasing by about $4,500 from principal paydown plus that $12,000 in appreciation. Your true net gain in year one is approximately $13,380 on a $30,000 investment after all expenses. That's a 44.6% return on your actual cash invested. Meanwhile, your $30,000 in the S&P 500 at an average 10% return made you $3,000. No phone calls from tenants, no maintenance, no stress. But $3,000 versus $13,380. This is where it gets really interesting though, because this comparison still isn't complete. Here's where stocks start to claw back, and I mean aggressively. The beauty of the stock market is compounding with zero friction. You invest $30,000, it grows to $33,000 in year one, and in year two, you're earning 10% on $33,000, not $30,000. There's no maintenance, no vacancy risk, no property management fees. It just compounds. After 20 years, that $30,000 in the S&P 500, assuming the historical 10% average, becomes approximately $201,800. You didn't do a single thing. You didn't fix a leaky faucet. You didn't screen a single tenant. You opened an app once a year and smiled. Now, the real estate scenario after 20 years is harder to calculate because there's so many variables. Rent increases, property appreciation, principal paydown, potential refinancing, tax benefits. But let's be conservative. If your $300,000 property appreciates at 4% annually, it's worth about $677,000 after 20 years. Your remaining mortgage balance is roughly $188,000. So your equity is around $469,000 from a $30,000 initial investment. $469,000 versus $201,000. Real estate wins by a landslide on paper. But, and this is a big but, that $469,000 assumes you dealt with every headache, covered every repair, handled every vacancy, and never had a nightmare tenant who trashed the place and cost you $15,000. The stock market number assumes you literally did nothing. And this brings me to what I think is actually the most important part of this entire debate, and it has nothing to do with math. It's psychology. Look, studies from behavioral finance researchers like Professor Brad Barber at UC Davis have shown consistently that the average individual stock market investor drastically underperforms the market because they can't leave their money alone. They panic sell during downturns. They chase trends. They check their portfolio 17 times a day and make emotional decisions. The average equity fund investor earned roughly 6.8% annually over the past 30 years.
while the S&P 500 returned about 10.2%. That gap, that's not a math problem. That's a behavior problem. And here's where real estate has a hidden, almost unfair advantage. You can't panic sell a house. It takes 30 to 60 days minimum to close a real estate transaction. There's no button you can press at 11 p.m. on a Tuesday because the market dropped 3% and some guy on Twitter said the economy is collapsing. Real estate forces you to be a long-term investor, whether you like it or not. And for most people, that forced patience is worth more than any spreadsheet advantage. Think of it like this. The stock market is like having an unlimited buffet with no rules. Technically, the best strategy is to eat a balanced, moderate meal. But most people pile their plate with garbage and go back 4 times. Real estate is like a meal plan that's pre-portioned and delivered to your door. Theoretical best meal, but you're way more likely to actually follow through. Now, you might be thinking, Luis, just tell me which one to pick. And I hear you. Here's my honest answer. If you are disciplined, you have a long time horizon, and you genuinely will not touch your investments for 20 plus years, index fund investing is incredibly powerful. It's simple, it's low cost, and the math works beautifully if you can behave. If you are someone who wants to accelerate your wealth, you're willing to put in the work, and you understand that leverage is a tool that amplifies gains and losses, real estate will likely build you more wealth faster. But it comes with real risk and real responsibility. And honestly, the actual best answer, the one that nobody in these debates wants to say because it isn't clickbait, is both. Use the stock market as your foundation. Automate investments into a low-cost index fund every single month, no matter what. Then, when you've built up enough for a down payment, add real estate to create leveraged growth and diversification. Here's what I want you to do this week. First, if you don't already have an investment account with automatic contributions going into a broad market index fund, set that up. Even $100 a month. Start the compounding engine now. Second, calculate your actual savings rate and figure out how many months it would realistically take you to save a down payment for an investment property in your market. Just the math, no emotion. Third, run the rental numbers on a property you'd actually consider buying. Look at the purchase price, estimate the rent, subtract the mortgage, taxes, insurance, and maintenance, and see if the cash flow works. If it doesn't, that's fine. It means you know. Knowledge is the advantage here. And fourth, write down your number one financial goal and your honest assessment of your own behavior. Are you the type of person who can ignore a stock market crash and keep investing? Be honest with yourself. That answer will tell you more about which strategy is right for you than any spreadsheet ever could. Look, the real estate versus stocks debate will never end. There will always be someone who made a fortune flipping houses telling you stocks are a waste of time. And there will always be someone who retired off index funds telling you landlording is a scam. The truth is somewhere in the middle, and it depends on you, your discipline, your timeline, your risk tolerance, and your willingness to put in the work. But here's what I know for sure. The worst investment strategy is the one you never start. So pick one, take action this week, and adjust as you learn. If this video helped you see this debate more clearly, hit that subscribe button, because we break down stuff like this every single week. Drop a comment below and tell me, are you team real estate, team stocks, or team both? I genuinely want to know. All right, I'll see you in the next one.